Thursday, 3:47 a.m. Eastern Time. A risk manager at a Tier 1 bank, let's call him David, though he feels more like Goliath tonight, wakes not to his alarm, but to the cold, silent pulse of his phone on the nightstand. It's not Bloomberg. It's a custom alert he set up last month, half as a joke, monitoring a subreddit he was told to watch. The notification reads, Phase 2 complete. 1.2 million Oz physical, 14 countries, 90 minutes. For a moment, the darkness of his penthouse is absolute. Then the numbers begin to compute. His bank's aggregated short position in silver, a trade so old and so stable it's considered a foundational hedge, is now bleeding an estimated $28 million per hour. He doesn't reach for the coffee. He reaches for the panic button, the secure line to the head of commodities trading. This isn't a market move. This is a targeted strike. And the weapon isn't a billion-dollar fund. It's an idea, replicated across a million screens. This is not 1980. The Hunt brothers had a boardroom. This army has a forum, and their war is just beginning. This isn't a story about silver, not really. It's a story about a promise printed on paper, typed into ledgers, and traded on glowing screens for generations. The promise that a piece of paper representing a metal is as good as the metal itself. It's the promise that built modern finance. And right now, as you read this, that promise is being called due in the oldest currency known to man, physical weight. Imagine waking up tomorrow, not in a vague sense, but tomorrow, and the price of silver has doubled, not over a year, not in a steady climb, doubled. The financial news explodes with theories, a solar panel boom, a supply chain collapse, a central bank gone rogue. But you'd be wrong. The cause is simpler and far more dangerous. The banks themselves, the very institutions that wrote the rules of this paper game, are trapped. And the key to the lock isn't in a vault. It rests in the collective will of millions of ordinary people who decided to buy the real thing. You might think, I don't own silver, this isn't my fight. That is the most expensive assumption you could make today. Every dollar in your 401k, every share in your ETF, every bond in your portfolio is interconnected in a system built on that same paper promise. When one foundational pillar shakes, the tremors reach every corner of the global financial cathedral. Your wealth, your security, your future is tied to the integrity of a game you didn't know you were playing. This is not theory. This is the cold, hard mechanics of leverage meeting an immovable object. And you are in the room. Let's break the game down, because at its heart, it's devastatingly simple. They call it a short squeeze. Sounds technical. It's not. It's a trap snapping shut. Picture this. A bank borrows 100 ounces of physical silver from a vault. It immediately sells that silver on the market for today's price, say $30 an ounce. The new player is different. The new player is a dental hygienist in Ohio named Sarah. Sarah saw her parents' retirement gutted in 2008. She sees the endless money printing. She doesn't trust the whispers. She bought 47 ounces of physical silver last month from an online dealer. It arrived in a plain box. She felt its weight. She put it in a safe. Sarah is not alone. She's part of a quiet, global migration. It's not driven by a single guru or a hedge fund prospectus. It's driven by a dawning collective understanding that paper wealth can vanish with a keystroke, but an ounce in your hand cannot be hacked, devalued, or defaulted on. This isn't speculation. It's preservation. And they are buying not ETF shares, not futures contracts, but the actual metal, coins, bars, the stuff you can hold. This migration is creating a silent, critical vacuum. The available deliverable physical silver in the official exchange warehouses, the grease for the entire paper machine, is shrinking. The latest COMEX data shows a registered inventory of just 35 million ounces. That sounds like a lot until you realize the paper claims against it are over 100 times larger. For every ounce of real silver sitting in those vaults ready to go, there are over 100 pieces of paper promising it to someone. The dam is holding back not a river, but an ocean. And the water is rising. History doesn't repeat, but it often rhymes. The rhyme here is chilling. In the late 1970s, the Hunt brothers, billionaires from Texas, tried to corner the silver market. They bought vast amounts of physical metal and futures contracts. They believed in scarcity. Their buying pressure against a relatively small paper market sent the price from $6 to nearly $50 an ounce in 2 years, a 1,300% spike. The establishment panicked. The exchanges changed the rules overnight, banning new purchases. Margin calls crushed the Hunts. Banks were bailed out. The squeeze was broken by the rulemakers. But today's story flips the script. Today, the banks are the Hunts. They are the ones massively short, selling what they don't have. And the new buyers, the Sarahs of the world, aren't a single billionaire target. They are a decentralized, global phenomenon. You cannot ban millions of people from buying physical property. You cannot change the rules on a sovereign individual holding a coin in another country. The paper market is centralized and controllable. The physical market is not. The modern rhyme isn't 1979, it's 2021. GameStop. A handful of hedge funds bet billions that GameStop stock would fail. They sold shares they didn't own, shorting it. A decentralized army of retail investors on Reddit saw the absurdity, saw the overleverage, and bought. Not with billions, but with hundreds of millions of coordinated dollars. They bought the stock and, crucially, refused to sell. The price exploded from $20 to over $480. The shorts were caught. Melvin Capital, a giant, lost over 50% of its value and needed a $2.75 billion bailout. The establishment was stunned. The rulebook was thrown out. It proved one thing. In the digital age, collective action could overwhelm even the most sophisticated financial models. Now, translate that lesson to silver. The scale is exponentially larger. The asset is foundational to the financial system itself. And the play isn't about a dying mall retailer, it's about the bedrock of money. If GameStop was a skirmish, silver is the war for the capital itself. Let's pause on the most important word in this story. Delivery. The entire paper edifice rests on the assumption that settlement will happen in cash. It's an abstract dance of numbers, but every futures contract, deep in its fine print, gives the holder the right to demand the physical metal. It's a nuclear option, rarely used, until it is. Here's the catalyst, the spark in the powder keg. It's not a slow trend, it's an event. Imagine a major, physically backed silver ETF, a fund that holds real bars to back its shares. Due to its structure, it must add physical metal when new shares are created. One day, a large institution, a pension fund, a sovereign wealth fund, decides to convert its massive ETF position not into cash, but into physical delivery. They want the bars. They file the paperwork. The ETF custodians go to the London or COMEX vaults to acquire the necessary 15 million ounces. But the market is tight. The available unencumbered bars aren't there at the quoted price. They must scour the globe, paying premiums, draining other vaults, news leaks. A fail-to-deliver notice is issued. It's a small line on a regulatory filing. But on trading desks, it flashes like a scarlet letter. That notice is a crack in the dam. It proves the paper promise can be broken. It asks the one question the system fears. Where is the metal? From that moment, the psychology shifts. Every other ETF holder thinks, if they can't get it, can I? The fear of being last in line triggers a run. Not a run on a bank, but a run on a metal. Holders of paper contracts, from small investors to other banks, start exercising their delivery rights, not because they want a ton of silver in their garage, but because they want to prove they can get it. They want to stress test the promise. This is the tipping point. The system moves from a state of confidence to a state of validation. And in that state, the mountain of paper contracts collapses under its own weight, seeking a foundation of physical reality that simply isn't there in the required quantity. The skeptics are already speaking. I can hear them. Their objections form a wall of apparent reason. Let's break that wall down brick by brick. Objection 1. The regulators or exchanges will just step in, they'll halt trading, change the rules, or force cash settlement. They will try. They did in 1979, they did during GameStop. But there's a limit. Halting the paper futures market is one thing. Halting the global over-the-counter market for physical silver is impossible. The price will simply flee the controlled exchange and be set in London, Zurich, or Shanghai at a massive premium. The paper market becomes irrelevant, exposing its artifice. Forcing cash settlement on a contract that promises metal is an admission of systemic failure. It tells the world the emperor has no clothes, or in this case, no silver. Objection 2. The banks are too powerful. They will collude, manipulate, and crush the price on the paper market to save themselves. This is their oldest play, and for a time it might work. They can sell massive amounts of paper contracts, creating the illusion of supply, hammering the price down to trigger stop losses and shake out weak hands. But this tactic has a fatal cost. It increases their already gargantuan short exposure. They are digging the hole deeper. Each hammer down requires selling more paper promises they cannot back. It's a short-term anesthetics with a long-term lethal dose. And with each cycle, more retail buyers, seeing the manipulation, become more resolved. They buy the physical dip, further draining the vaults. The bank's weapon becomes their poison. Objection. 3. It's just a theory. The paper market has always worked. Why would it fail now? Because the fundamental ratio has changed. For decades, the paper market was a game amongst paper players. Now, a new, physical-minded participant has entered the casino and is demanding real chips, not plastic tokens. The system was never designed for a mass conversion event. It was designed for perpetual motion. The why now is the convergence of awareness, technology, and tangible fear about the stability of the entire financial system. The catalyst isn't economic, it's psychological. The faith in paper is eroding. Now feel the storm. It's 11:04 a.m. on the New York trading floor. The air, usually buzzing with 100 low conversations, has gone thick and silent, broken only by the frantic clatter of keyboards and the sharp, guttural curses that come not from anger but from primal fear. The scent of cold coffee and stale sweat hangs over the rows of screens, all flashing the same relentless, upward-slashing green numbers for silver. A senior trader, Mark, who survived '08 and the flash crash, feels a cold trickle of sweat trace his spine beneath his custom shirt. His screen isn't showing charts anymore, it's a cascading waterfall of margin call alerts, each one a multi-million-dollar demand for more collateral he doesn't have. His risk management dashboard is a sea of red so deep it looks like a graphic design error. He picks up the direct line to the credit department. It's busy. He tries the head of desk. Busy. For the first time in his 20-year career, the system is ignoring him. He is alone inside the machine as it breaks. His finger hovers over the liquidate all button. But to liquidate, he must find a buyer in a market where every algorithm is screaming to buy, not sell. The bid-ask spread, usually a tight penny, is now $5 wide and widening. The market isn't moving, it's gaping, it's tearing. This is the moment the models never accounted for. Not just volatility, but the total evaporation of liquidity. The promise of a market where you can always buy or sell shatters. You can only buy, because everyone is trying to buy back what they sold. The music hasn't just stopped. The orchestra has fled the building and the doors are locked from the outside. This is where you stop being a spectator. The narrative shifts from what is happening to where are you in this? Your position in the financial ecosystem determines your risk and your potential power. Let's map it. If you hold physical silver or gold in your own possession outside the banking system, you are, in this scenario, holding potential energy. The metal is your anchor. Your action is not panic, it is patience. The first violent spikes will be paper-driven and volatile. The real revaluation happens when the physical market fully decouples from the paper price, trading at a massive premium. Your discipline is to hold through the noise. Do not sell your anchor for digital dollars that are losing meaning by the hour. Your leverage is your refusal to participate in the paper panic. If you hold paper silver, ETFs like SLV, futures contracts, or mining stocks, understand precisely what you own. You own a financial derivative, a claim on a system under historic stress. ETFs have mechanisms to handle redemptions, but those mechanisms depend on a functioning, liquid physical market. In a true squeeze, that breaks. Mining stocks are equities. They can be manipulated, halted, and are subject to broader market crashes. Your action is vigilance. Know your exit points. Have a plan that is not based on hope, but on specific price levels or fundamental triggers, like a confirmed fail-to-deliver event at a major ETF. Your risk is counterparty failure. If you hold none of the above, watching from the sidelines, your first action is not to buy anything, it is to understand. The shockwaves will hit all assets. Tech stocks, bloated with leverage, may crater as liquidity is pulled. Bonds may swing wildly as faith in currency is tested. Your portfolio's apparent diversity may vanish as all correlations move to one, fear. Your defense is knowledge. Begin tracking the tangible metrics. The COMEX registered inventory, published every Wednesday afternoon. Watch the gold-silver ratio. Listen not to the financial media's explanations, but to the raw data from the vaults. Your move from here is not based on FOMO, but on forensic analysis of a braking system. We are now at the inflection point. All the gears are meshing. The physical drain, the historic paper short, the decentralized awareness, the fragility of the ETFs, the desperation of the trapped shorts. The math is brutal and beautiful in its simplicity. If just 5% of the outstanding paper-silver contracts decided to stand for delivery, it would require more physical silver than exists in all the known exchange vaults combined. The system is a promise that can only be kept if almost no one asks for it to be kept. The moment a critical mass asks, the promise implodes. This implosion won't be a slow-motion film. In the digital age, it will be a cascade of blinking lights. A margin call at Fund A forces liquidation, spiking the price, triggering a margin call at Bank B, which buys desperately, spiking the price, triggering a failure to deliver at ETFC, which causes a regulatory halt, which spills panic into the physical market, where the price gaps up 30% in London before New York even opens. It's a feedback loop of pure financial adrenaline. The media will call it a market anomaly, speculative frenzy, or irrational exuberance. They will be wrong. It is the exact opposite. It is the market becoming rational. It is the price discovery mechanism, after years of manipulation and paper dilution, finally hunting for the true value of a scarce, tangible monetary asset in a world of infinite digital promises. It is not irrational. It is a reckoning. So, what do you do right now, tonight, as this clock ticks? First, breathe. This is not a call to reckless action. It is a call to conscious positioning. Look at your portfolio, not just the balance, but the nature of each holding. How much is a digital claim on a complex chain of promises? How much is tangible, outside system asset? I'm not just talking metals. I'm talking land, productive skills, community. Rebalance your concept of wealth from notional value to resilient value. Educate yourself obsessively. Go to the source. Read a COMEX warehouse report. See the 35 million ounces. Look up the bank participation report from the CFTC and see the net short position of the commercial banks. The data is public. The story is in the footnotes. Become your own analyst. Make a decision, not a trade. Decide what role, if any, physical precious metals play in your long-term plan for preservation. Is it insurance? Is it a strategic asset? Your decision should be philosophical first, financial second. Then, execute that decision with discipline, ignoring the daily noise. Build your network. Connect with others who are thinking in terms of systems and fundamentals, not headlines and hype. Shared knowledge is a shield against panic and manipulation. And finally, watch the clock. The next major CFTC bank participation report is released on Friday afternoon. It will show if the big banks increased or decreased their historic short bet. That data point is a direct thermometer in the patient's mouth. The reaction to it across social media and trading floors will be your clearest signal of the rising temperature. Fortune, in times of systemic shift, does not favor the bold. It favors the perceptive, the prepared, and the patient. It favors those who can see the crack in the dam, while others still admire the serene lake behind it. This story about silver is really a parable about truth. The financial world has constructed a magnificent palace of mirrors, where reflections of wealth are traded for other reflections. Silver and gold are the stones in the foundation. They are inconvenient. They are heavy. They cannot be copied with a click. They are truth. And when you demand truth in a hall of mirrors, the glass must shatter. The short squeeze is not the goal. It is the symptom. It is the violent market-driven correction to a decades-long lie about abundance, about promises, about what truly holds value. As the first light of dawn now glints off the towers of lower Manhattan, the night's digital panic settles into a cold morning reality. The numbers on the screens have paused, but the tension has not broken. It has been absorbed. The risk manager, David, is still on the phone. The dental hygienist, Sarah, checks the news before her first appointment. The metal in her safe hasn't changed. Its role in the world has. The bell is about to ring. The market will open. And in that opening tick, a question will be answered, not by economists, but by physics and fear. Can a mountain of paper bury an ounce of silver? The answer will rewrite the rules. And you, whether you own an ounce or not, will live in the world that answer creates. The next chapter doesn't begin tomorrow. It begins with your next conscious breath. See the system. Understand your place within it. Choose your ground. This is more than a market event. This is the sound of a paradigm reaching its breaking point. Listen closely and decide what you will hold on to when the shaking starts.